What I wanted to do was provide a little bit of an update on the Southern Plains ag economic situation or financial situation. And as you might guess, there are some ups and some downs, some positives and some negatives. So I just wanted to kind of briefly go over where we're at and what things are looking at, particularly in Oklahoma, maybe with a little bit more of an emphasis to a little bit broader region than that. So let me see here. How do I make this thing go forward? There we go. Um, no doubt we've been in some challenging economic times. That's been true for about 6 years or so. Up until this past year, that's been more true for crop-based operations, particularly here in Oklahoma, than for our cattle operations or our very common mixed livestock and crop farms. But that assessment might be changing. For 2019, for example, I suspect when the results are all in and tallied up, it will be a more challenging year, or will have been a more challenging year for our cow-calf producers than we've had in a good long while, and that's primarily just driven by what has happened to prices. So I'm not sure I can make that statement as we look at 2019 and maybe 2020. It might be just as challenging for a lot of our livestock operations as it has been for our crop operations. And of course, the degree and type of financial stress, if you will, that an individual producer is facing is going to vary a lot depending on the individual producer, depending on their enterprise mix, their equity position, starting out into this economic downturn 5 or 6 years ago, weather patterns in their particular county or their particular situation, or other calamities that they may have or may have not faced. So it's going to depend a lot individually. As we look across the United States as a whole, and we'll see this a little bit more clearly in just a few minutes, but the dairy industry has been probably the one enterprise, if I had to pick one, out of all of U.S. agriculture that has been particularly hard hit over an extended time period. So if we look at a graph put out by USDA Economic Research Service of net cash income and net farm income, I don't have time to go into the details of the differences between those two numbers. Let's suffice it to say net cash farm income is a little bit of a misleading measure. It's kind of an important indicator of the cash position of our farms and ranches across the United States, but it's definitely not a measure of profitability. And the vast majority of the time, it comes in a little higher than true accrual inventory adjusted net farm income, which is a better measure of profitability. As you can see from the graph, the last 2 or 3 years, we've been on an upward trend, kind of gotten back up to at least the recent long-term average. Certainly not the great years of the early 2010 decade, but certainly better than than the position we've been in for the last few years. I think that's in general pretty representative of where the ag industry is and has been. But if we dig just a little bit deeper into those numbers, a couple of things that come out, maybe some things that are positive. The 2018 final numbers, of course, we don't get the final numbers until about 6 or 8 months after the fact. Those numbers came in significantly better than we were forecasting, not we being myself, but USDA and other economists in the business of forecasting such things. 2018 came in a little bit better than anyone would have predicted. And the current forecast for how the 2019 numbers will ultimately pan out is certainly a continued improvement for the U.S. overall. I will point out, and this is kind of key as we look ahead to the next year or so, a lot of that improvement or a lot of that surprise to the positive side had to do with two important factors. One was some ad hoc assistance money that came in really across the United States, the market facilitation program payments. Of course, those were structured a lot differently in 2019 than they were in 2018. In 2018, those were primarily based on what the individual farm produced and the payments that had been calculated for those respective commodities. In 2019, those payments were much more structured based on the county average production history. So a producer that was producing crops that were a lot different than the historical county average might have come out better or might have come out worse in 2019 relative to what they actually produced. There's been quite a bit of argument about which of those two methods were more fair. I'm not here to argue or justify the method used in 2019 or the method used in 2018. Just suffice it to say it was a lot different, and individual producer payments were a lot different for 2019 than they were for 2018. We'll come back to that MFP issue here in just a few minutes. The other factor that made the overall nationwide results come in better in 2018 and 19 than were projected had to do with input costs coming down. That's not an incredible surprise as we reduce the demand for things like fertilizer and some of the other major inputs that go into the ag sector. Some of those prices tend to mitigate a little bit, and that had a big impact on those net income projections for 18 and 19. As we think about going forward, and specifically as we think about Oklahoma agriculture, number one, it's unlikely that there will be a market facilitation program payment. There's been a lot of argument politically that we need another round of that in 2020. We'll see how that pans out. But at the current time, it appears to me probably less likely that there will be that series of payments than that there will be. There might be some other types of payments that kick in to kind of replace some of that, but that ad hoc program payment is more likely than not to not be available for 2020. On the other hand, input costs are not likely to see a tremendous upward pressure, so our cost structure may remain kind of in line as we think about 2020. And the final point that I have on this slide, calf prices lower than the last several year average. That's going to continue to put pressure on our cow-calf producer returns and kind of drag them down in addition to our crop producer returns kind of being in the tank. So those things kind of overall don't paint an incredibly rosy picture. If we look at kind of the dramatic response to financial stress, going out of business, going broke, maybe filing Chapter 12, we don't have a lot of good contemporary information on Chapter 12 filings. We get some summaries kind of after the fact. The Farm Bureau folks put this together kind of late in 2019. So it doesn't capture what happened very late in 2019, and I want to pick up on that. But if you were to just look at this visual image, you might get the impression that things are just really horrible in, say, Kansas, Oklahoma, maybe some of the northern states, because just looking at this graphic portrayal, it looks like bankruptcies are way up in those states. And it's true. As of mid to late 2019, bankruptcy filings were up in Kansas in particular and Oklahoma, where we're situated, relative to the year earlier. But the thing that isn't shown on this graph is that bankruptcy filings were at extremely low levels from a historical perspective before 2018. So not a tremendous uptick numerically, but a fairly large uptick percentage-wise, leading to some concerns, but maybe not the panic that you would feel if you just looked at that chart without actually having the background information. Then the question is, what happened in 2019 and later on in 2019? Well, we don't really know for sure, but we have some very specific information about Wisconsin, for example. Whoops, I went forward twice there, and I didn't mean to. Let me see if I can back that up. There we go. Excuse me. One of the things that we know that happened in Wisconsin, because it has been widely reported in the news lately, is that they lost 10%. Put that number in your head. They lost 10%, over 800 dairies in calendar year 2019 alone. Well, if you were to look at this chart, which represents 2018, you wouldn't get the sense that there was kind of a financial crisis in agriculture in Wisconsin. But after the numbers came in for 2019, we know that there is some tremendous financial stress in the state of Wisconsin, for example, because that's one that's been in the news a lot lately. Losing 10% of a particular type of farm in 1 year in one state. I would call that relatively significant. What that means for us here in Oklahoma, well, we're not real sure yet, but let's continue telling the stories. Surveys of lenders, that's one potentially reliable source of information that we have, consistently reveal that ag conditions are steadily getting worse rather than improving. However, the majority of those lenders that have been surveyed also consistently report that deterioration, if you will, that level of getting worse, is in general modest. In other words, we're getting worse, but we're getting worse at a relatively slow pace. That's been the case for at least 4 years in a row, and that confirms our suspicion that this downturn is in general a slow erosion of financial condition, which is much different than what happened in the 1980s. And there are a number of reasons why it's different than it was in the 1980s. We had stronger balance sheets going into this downturn. In 2013, our farm balance sheet was in general very strong. We've had steady and historically low interest rates throughout this downturn, as opposed to what happened in the late 1970s and early 1980s. And we've not, and partly because of those two factors, we have not seen the dramatic and rapid decrease in agricultural land values, which of course represent about 80% of the asset side of the average farm balance sheet in the United States. So a lot of differences between now and the 1980s, but for individual producers, certainly the level of financial stress and the level of financial pain is every bit as serious. If we look at loan demand versus availability of funds to loan to agricultural producers, where I think we're starting to see maybe some improvement. And at least on the loan demand graph, the top line on this chart that I'm showing here on the screen, loan demand not as strong as the lenders actually anticipated, meaning that maybe producers are figuring out ways to get by without borrowing as much new money as perhaps the lenders anticipated might be needed. And there are some funds available to satisfy those loan demands, as indicated by the bottom line on the chart. This, of course, is information that comes from at least one of the Federal Reserve districts that's heavily involved in agriculture, the 10th District Federal Reserve. By the same token, if we look at individual enterprises and expected repayment problems as surveyed in 2019, looking forward to early 2020. The interesting thing here is to look at which bars are getting worse over time, getting further negative, and which bars are kind of receding or maybe not looking quite so bad. And the obvious conclusion that I get from looking at this particular chart is that at least in the minds of the lending community, it's going to get tougher for wheat producers, cow-calf producers, feedlot type producers, or cattle feeding operations going forward. Those bars are getting more negative, longer to the downside, and some bars that might be improving in 2019 relative to previous years are perhaps the dairy industry, maybe the hog industry, and maybe our friends in the Corn Belt might not feel quite as much pain looking forward as they did perhaps in 2018, looking forward to 2019. Of course, that doesn't bode well for at least Oklahoma, because we're kind of a wheat, cow-calf, or cattle feeding type of a state. So that's a little bit concerning. If you look geographically at loan repayment problems, or maybe anticipated loan repayment problems, if we look at the percentage of loans on the watch list or identified as classified, or actually loans that have developed into some real problems, as reported by the 10th District Federal Reserve lending community, we see Kansas and Nebraska ranking a little higher in terms of anticipated loan repayment problems than say Oklahoma. That's been fairly consistent. A little bit of an uptick in the bar there for Oklahoma in terms of loans that these lenders might be kind of keeping an eye on, but not nearly as severe of anticipated problems as what we see in some of our neighbors, Kansas, Nebraska, or even the 10th District as a whole. So maybe that's a little bit of good news. Maybe that's a positive factor to consider as we think about Oklahoma, or even more broadly, Southern Plains agriculture. Certainly a stabilizing influence on the ag finance situation over the past several years has been the relative stability of ag land values, or farmland values in general. Here in Oklahoma, at least in calendar year 2018, we don't have the 2019 numbers summarized yet, but I don't think we're going to see a tremendous amount of change. Ag land values either up or down just very slightly. Pasture up a little bit, cropland down a little bit by just a few percentage points. Not nearly as dramatic of moves as we've seen even in our neighbor to the north, Kansas. Their ag land values have been down a little bit more than our land values here in Oklahoma. But again, nothing as dramatic as we saw 30 or 40 years ago as we went into the 1980s. One of the things that might be just a tad bit concerning, and some others may weigh in as to whether they're hearing the same thing, but I'm starting to hear, at least from our real estate marketing firms, our realtors and our auction companies, some concern regarding the volume of land that they see coming on the market as we go into 2020. Maybe a few more pieces of land, a few more tracts coming on the market. Will that supply kind of overwhelm the demand? Are there enough people out there with enough money to hold those values up? That might be just a tick of a concern as we look forward, if we see a little bit more land start to come on the market, on the real estate market. So I've kind of summarized a few positive factors, a few things that I think are maybe positive indicators as we look to 2020 and beyond. And I've also tried to summarize a few negative factors. The biggest positive factor, or one of the big ones that I see, is instead of continuing to go up, interest rates have stabilized over the last year or so and even come down slightly relative to year and a half ago levels. Year and a half ago, the big talk was, well, okay, how fast are interest rates going to go up and how much? I'm not hearing that talk anymore. I'm hearing more stable. If we see any increases, they're going to be very modest. We might even have the opportunity for a few more slight breaks in interest rates in general. But I think probably the word is steady. Not a whole lot of pressure either way on interest rates at this point in time. Our other primary cost components, whether you're a livestock producer or whether you're a crop producer, our other cost components appear to have stabilized at a lower level than perhaps a few years ago. A lot of our input prices are at least staying in line. Yes, we'd like for them to come down and be lower, but they're not taking off to any large degree. And overall, agricultural product exports have been surprisingly strong, despite all the talk in the media about the trade war. Actually, that one was fairly predictable to a lot of those of us in the economics world. Trade disputes are huge when you look at one country. In this case, the big one is, of course, China. But world trade flows adjust. What we did is we created a little bit of an inefficiency in the product distribution market, but we really didn't create any big hole that wasn't going to be filled by something. So we created an inefficiency, maybe took a little bit off of some commodity prices, but not as big a factor as some made it out to be. And at the same time, the trade dispute gave us a political excuse to argue for market facilitation payments, which some have calculated to have, as a general rule, exceeded the losses that were incurred by the disruption in trade flows. That's probably not a 100% universally accepted opinion, but the bottom line is we were able to argue for and get some market facilitation payments, and we had some disruption in trade, but maybe not as much as some would have earlier predicted. Cattle prices, depending on how you want to come out on this, appear to be positioned to maybe improve over the next year or so. In other words, the cycle might have bottomed out. We might be looking at some stronger cattle prices going forward. I'm not the livestock guy anymore, so I don't follow that as closely as I used to. But maybe we've seen the bottom from the standpoint of that enterprise. If we want to think about some things that could go on the other side of the T account, maybe not so positive looking forward, maybe even could call it negative factors. Simple fact of the matter is we've just got a tremendous amount of grain out there in the world. So on the crop side, ending stocks are huge, world ending stocks are huge. Trade agreement progress might help us marginally, but the fact of the matter is there's a lot of grain out there in the world. There's not any impetus for a huge rebound in crop prices. Again, the trade resolutions, since at least in my opinion, the negative impacts of the trade dispute were not as serious as some had projected. I would also say the positive impacts of any resolution to those trade disputes will be marginally positive, but maybe not as positive as some people would like. With that said, if we do get some resolution to all of the trade issues, it's going to be harder to argue for an ad hoc government assistance payment an MLA payment or something similar to make up for the impacts of a trade disruption. So those are kind of some negative factors as we look forward to 2020, 2021. Purdue University Center for Commercial Ag has started doing this monthly survey of 400 or so producers across the country, heavily focused on the Corn Belt, but not exclusively focused on the Corn Belt. Different 400 producers each month. And as you can see, that index of the strength of the ag economy, if you will, bounces all over the place. That's kind of the first observation on any news that's in the headlines on the day that the survey comes out. It's going to heavily drive survey responses. But by and large, over the last several months, the optimism in the ag community in general has started to improve, as indicated by the green line there. Farmers in general think that things are going to get better. The index of current conditions bounces all over the place, but it's at a higher level than it's been for several years, even though it came down just a tad in the most recent survey. So there's some optimism out there on the part of the ag community in general, again, heavily driven by Corn Belt responses. So keep that in mind. That same survey asks if individual survey respondents think they might be making some large capital investments at any time in the near future, and the proportion of people who think that they might be in a position to buy some stuff, machinery, equipment, buildings, those kinds of things, is at a higher level than it's been for a long while. So at least some agricultural producers are starting to become willing to consider making some large capital purchases going forward. So that might be interpreted to be a positive sign. Again, the caveat here, highly driven by Corn Belt responses, not so much Southern Plains, although they do survey a few participants outside the Corn Belt. The optimism about a resolution to the China dispute continues to improve in general. Took a little bit of a dip in December relative to November, but we've noticed that the percentage of respondents that think that the dispute will be resolved in a favorable way continues to increase relative to the number of survey respondents that don't think that dispute will be resolved in a favorable way. That's, of course, largely driven by the recent news of a quote-unquote phase one resolution to the issue. Now everybody's waiting on China to come in and start to make some of these large-scale agricultural commodity purchases that they promised in the phase one agreement. Of course, we have to consider the fact that China and trade with China and trade flows with China, and not only with China, but around the world, are going to be hampered a little bit by some other problems that are currently being faced by China in particular, but around the world. The coronavirus, etc. People aren't going to be traveling as much. They have other things to worry about besides buying commodities or locking in commodities, at least in the short run. So I expect that to be just another little bit of discouraging news as we try to convince China to buy more agricultural products. We're going to have to give them a little bit of grace and a little bit of time to resolve some of these other issues that they're faced with before we start to worry about major agricultural purchases. Not to say that they won't make agricultural purchases, but they're probably focused on some other things, at least in the short run. One of the things that I talked about at last fall's Rural Economic Outlook Conference, just something that really stood out very, very blatantly, very strongly. As we look at the number of ways that we can kind of digest the information from the 2017, the most recent census of ag. One of the things that just stood out to a number of us was that we had 19 counties, and actually about 10 more than that, about 29 counties in total, that lost around 10% of their farms and ranches between the 2012 census and the 2017 census. That's a lot of counties. That's a fourth or so of Oklahoma counties that lost 10% or more of the farm numbers in a fairly short time period, not like Wisconsin losing 10% of their dairy farms in 1 year, but certainly still a fairly dramatic shift in the demographics out there in Oklahoma ag. We had some counties in Oklahoma that gained a large number of farms, but those are primarily really small farms catering to some very specialized markets, probably around some large population areas like the Oklahoma City metro area or the Tulsa area. Some of those counties gained in farm numbers, but they're not going to represent a large amount of agricultural production. So again, the demographics in ag are changing. They're changing in Oklahoma. That has some implications for our Oklahoma economy. So we're still in tough times. We're probably still going to be in tough financial times in 2020. It might marginally be a little better than it's been for the last few years, but there are certainly some negative forces at play. As always, for commodity crop producers, it's all about cost management. Find a way to cut, I suggest $20 an acre for a wheat producer or a corn producer or a soybean producer in Oklahoma. Find a way to cut $20 an acre off of those costs. That may be a temporary cost adjustment. It may be a long-term cost adjustment, but to get through the tough times, focus on cost management. That strategy is working well for a lot of the producers that I personally work with. Unfortunately, in some cases, one of the ways producers are finding to do that is to shop around for inputs and get the same inputs that they've been buying locally shipped in from somewhere else at a cost savings. That, of course, helps the individual farm, but it's not doing a lot for some of our input suppliers, local input suppliers in Oklahoma. There's the trade-off, and it's a very real trade-off, and we have some agricultural input suppliers in Oklahoma that are facing some pretty challenging times because they simply can't achieve the volume levels on some of these inputs to compete with some of the broader markets. So that's just another reality of the world that we're faced with. Looks like it's going to continue to be tough in 2020, at least for our crop producers. Wheat looks especially challenging. Prices have dropped off more dramatically for wheat than they have for even some of the other commodities. And that's even after considering the rally of the last month or so, month and a half or so. We still didn't come back to levels that put us up to levels anything close to where we were at a year or so ago, as opposed to something like corn or soybeans. They bounced around a little bit, but in general, if you look at today's price relative to a year or so ago, we're not down anywhere near as much for some of those commodities in percentage terms as we are for wheat. With that said, most Oklahoma producers are basing their decisions, at least their farm program decisions, off a wheat base. That's not 100% true for every producer, but it's to a large degree true in Oklahoma. The price loss coverage program, that option of the Farm Bill decision, might provide some assistance for the 2019 and 2020 crop year. If we're unlikely to get an MLA payment in 2020, what we might get is a PLC payment for those producers with wheat base that will come along in about October of 2020. And that payment might be relatively significant for a lot of our producers. Who knows what will happen for the 2020 crop year, but it's looking fairly likely that the PLC program, if you have wheat base, might kick in for 2020. So people need to think long and hard about their farm program election that's being made right now. In summary, it's no surprise we're in an extended period of very challenging financial times for our agricultural producers. With that said, it looks a lot more like the 1920s than the 1980s. The 1920s were an extended period of kind of a slow erosion of financial position for farms and ranches in general in the United States. Prices at a level that were slightly below costs of production, and we just continued to eat away at farm financial position until things finally started getting better as we started to position ourselves to play a role in World War II, for example. The 1980s was a very dramatic and very rapid erosion of financial position and performance in U.S. ag. Rapidly rising interest rates, rapidly declining asset values, kind of threw us into a balance sheet crisis at the same time that we had a cash flow crisis. Right now, it's a cash flow and a profitability crisis. For most ag producers, it's not really a balance sheet crisis as a general statement. Obviously, there are exceptions to that rule. Our producers seem to be weathering the storm fairly well. Again, there are individual exceptions. There's some signs that conditions might get better in the next year or so. At this point in time, I'd say that's especially promising maybe for our cow-calf producers, that prices will improve at some point in the next year or so. I can't guarantee that. I'm not necessarily making that as a solid prediction, but it just looks like we're shaping up to the point where things might get a little bit better, especially for our livestock producers. Continued tight margins for our crop producers. I would ask those of you on the webinar, if you wouldn't mind, click on the survey link there really quickly. Only a couple questions on that survey. We'd like to get your responses to those. If you'd like to be added to our list for the Ag Finance newsletter, if you're not already on that, send myself an email. That's probably one of the quicker ways. Send Brent an email if you have his email address, and we'll get you signed up for that. Also, you can join up with us on Facebook. Almost daily posts on relevant farm management, ag finance topics there on the OSU Farm Management Facebook page.